Right now, everyday people all over the world are generating massive fortunes simply by tapping buttons on their mobile phones. From the outside, the stock market appears to be a digital casino. Beginners often treat it that way, picking random three-letter ticker symbols and hoping a green line moves in their favor. This approach is exactly why most people fail. They watch the numbers change without understanding what those symbols actually represent. To see how this wealth is actually built, you have to look past the glowing Wall Street screens and focus on physical assets, specifically dirt. Imagine a highly productive 8-acre farm owned by a single farmer. They hold the deed to the entire operation, the land, the equipment, the crops, and every cent of profit the farm generates. Picture that total ownership as a giant grid. If the farmer mathematically divides the farm into 100 equal pieces, each of those tiny squares represents a share. By purchasing one square, you acquire exactly 1% of the entire farming operation. This ownership model applies to global corporations. When you buy stock in Ford, you are purchasing a fractional deed to their assembly lines and heavy machinery. It works the same way for software giants like Microsoft. Each share represents a microscopic slice of their physical products, patents, and total revenue. Regardless of what a company produces, buying its stock means you own a piece of a real-world operating business. But why would a successful business owner give up their property? Our farmer might want to scale up by building an automated irrigation system or buying better tractors, but they lack the $500,000 in cash to do it. Taking out a bank loan is risky. It requires heavy monthly payments with high interest, regardless of whether the harvest is good or bad. Instead, the farmer sells 40% of the ownership. For immediate cash, investors receive a stake in its future. This is issuing stock. The business gains debt-free capital for growth, while avoiding the constant threat of a loan default. Selling shares allows a company to optimize its operations and expand quickly using the money provided by the public. A few years later, you might decide you need cash for personal expenses. However, the money you invested is already tied up in the farm's tractors and pipes. The farmer won't give you a refund, so you must find another person willing to buy your ownership deed from you. This is the purpose of a stock exchange. It acts as a massive, highly regulated auction house where millions of people gather to buy and sell these deeds. In the modern digital market, pressing buy on an app simply pairs you with a stranger halfway across the world who tapped sell at that exact same second. This creates a secondary marketplace where investors trade existing ownership stakes among themselves. If the number of shares is fixed, why do their prices move up and down every minute? Stock prices fluctuate based entirely on the law of supply and demand. This chart shows how prices react. If the farm has a record harvest, demand quickly outpaces the limited supply of shares. Owners demand a premium, pushing prices higher. Conversely, during a drought, nervous investors offer shares at lower prices, causing the price to drop. Ultimately, trading is about analyzing real-world operations, acquiring a piece of a business positioned to thrive, and eventually selling that ownership to the market at a profit.